Sir, I think, first of all, I think Jay did a fantastic job of outlining why they did this and giving us some guidance into how they're going to operate into the end of the year. The inflation expectation data, particularly the sentiment data that came out from the University of Michigan, I think really got the committee on edge and got them to think that they can't mess around with that. They can't mess around with 40 years of inflation fighting credibility that has been built up from Paul Volcker to Alan Greenspan to Ben Bernanke to Janet Yellen. And I think they're going to be pretty fierce about it. And that's what the 75 bips is. And I think the market, it's funny to talk to clients earlier this week and tell them, hey, I think the market would actually rally on a 75 and a strong Fed telling you they really are on top of this, rather than a weak Fed at 50 bips that said, hey, don't worry about it. We're just going to play fast and loose with these expectations. He did the right thing. He got the right market reaction. We'll see if it holds. I'd probably lean a little bit more short term in Gary's camp. We've come a long way down. Yeah, come a long way down. And, I haven't been that positive on your show for quite some time.
I'm curious why. I feel like the best bullish argument for the market right now is positioning, which isn't a very strong argument. I don't know, David, what are you thinking?
I think it's a little bit of positioning, a little bit of fatigue, a little bit of we've come a long way. But I'll tell you, so the one thing that's really got me thinking in the last few months about how deep this cut can go as we bring demand lower is that just nominal growth is so high. We had 12% nominal growth last year, and we're going to have maybe double-digit nominal growth this year with high inflation and modest low real growth. And it's just hard for assets like capital, real assets, whether it's capital, equity capital, real estate, or commodities to go down when there's that much nominal income growth. So if the Fed gets this right and doesn't do anything too stupid, too draconian, messes up demand too much, I think we actually got a pretty good chance of holding some of these levels, at least for a while, until we see what happens.
But doesn't it, really quickly, David, doesn't it depend on a soft landing? Chair Powell was asked about that. He sort of said he still thinks he can do a softish landing, but he didn't commit. He said, I don't want to be a handicapper. And he said there are things that are out of our control as well on the supply side of inflation. What does the path to a soft landing look like right now?
I don't think it matters as much as you're saying. I think the soft landing would be nice, but a modest recession, couple quarters of -1 to -1.5 growth, the unemployment rate back up in the high 4s, maybe low 5. We lose the 5 million extra job openings that probably are way too much out of the 12 million that we have. All that's healthy to me. So I think the stocks are going to look through a lot of stuff. It's the longest dated asset out there. It's permanent capital, and they look very much into the future. And as you were saying earlier, Sarah, there's an idea that as we get this 75 and we get more aggressive, that we get to the end sooner. So stocks like to get to the end sooner. So I don't want to. I don't know that we've set the bottom in this thing. Maybe we have, maybe we haven't. But I think we've come a long way, and you have to respect how much we've come. And you have to respect that there's a lot of dollars in the system coming from nominal income growth, and that's supportive in the end.
David Zervos changing his tune from Jefferies. Thank you very much for joining us with some Fed reaction.